All right, let's check out the Chapter 8 homework. This is problem number 1. And let's read through this. It looks like they want us to figure out Part A, the net accounts receivable. And then Part B, you're going to do a write-off of the accounts receivable. And then Part C, they want you to figure out what would be the net, again, the net accounts receivable at the January 3rd. And then they want to figure out if it had changed once you did that write-off. All right, so in the problem, they give you the adjusted balances of accounts receivable to be $800,000, and the allowance account is $55,000. So do Part A. Let me scroll down and let me show you this. All you do is you would take that $800,000, subtract out the allowance. Remember, that's the contra asset. So 800 minus 55,000 would give you your net accounts receivable of $745,000. So if you go back up, that's essentially what they want you to put for Part A. Now, on Part B, whenever you do a write-off, they again want you to write off $10,000 on accounts. What you do is you would debit the allowance account for $10,000 and then credit accounts receivable for $10,000. Now, the thing that's interesting about this is that you're debiting allowance and crediting accounts receivable. This ultimately has no effect on your net accounts receivable, because if you go back down and look at how you calculate your net accounts receivable, what you're essentially doing here is you can see how this 800,000 now becomes 790, and the 55,000 now becomes 45,000. So each of these are offsetting each other, and so because of that, notice that the net accounts receivable is still at 745,000. So that's why when they ask you in Part C, notice the net accounts receivable is still the same. And then in the second requirement, the question says, has the net accounts receivable changed? Of course, the answer is no. And again, they're showing you this right here, how this 800 went to 790, that went down by 10. And then the allowance also went down by 10. Because they offset each other, you still have the same NRV. All right, that's my comments on problem 1. Let's check out problem number 2. And on this one, they want you to do some journal recording. So it looks like we've got Part A. You have a note that they basically lent out some money. And then Part B, they're going to have us record some interest earned. This is going to be at December 31st. And they're going to receive the interest and the principal. So this problem is all about notes receivable. So to start with, they've got an $8,000 note. It's a 6-month note at 6%. And notice how they would debit notes receivable and credit accounts receivable. So notice this was basically the customer had owed them money, and so it had been long past due. So what the company did was they started to charge interest. So all they did was they converted that accounts receivable into a notes receivable, so simply by debiting notes receivable and crediting accounts receivable for that $8,000. Now, regarding the interest, since this happened on November 1st, you got November and then December, so you've got 2 months now. And if you remember, and I'll write this out, remember it's the PRT concept. So again, P, principal times rate times time. So if you would take that 8,000, multiply that by the interest rate, which is 6%, 0.06, times 2 over 12. I say 2, because remember the interest rate of 6% is always given as usually an annual rate. And from November to December, they have earned 2 months interest, and that'll give you right at, looks like it's $80. So notice what you do is you'll debit interest receivable and credit interest revenue. So that would be the second one. On then Part C, you want to get the interest at the full maturity. Well, you would have that 8,000 again multiplied by 0.06 times 4 over 12. That would give you the rest of the interest. That's going to give you $160. And you're asking, why did I do 4? Because remember, it's 2 months is the first 2 months, and then the last 4 months, which will be into the next year up to April, that'll be the other 4 months of interest that you would get. And that's where they'd get the 160. So to collect on all that, you would debit cash for the 240. When I say 240, That's the 80 plus the 160, that would be the 240. You're going to credit the interest receivable for what you created on that accrual. And then interest revenue is the other part of interest revenue that's recognized in the next period. And then the last one, you're just collecting the cash on the principal amount for the full 8,000. So let me show you, and then I think that's it. And then down below, again, they're just showing you these calculations I just showed you on how to calculate that interest. Okay. All right, so that's my comments on problem 2. Let's check out problem 3. And on this one, they want you to do a schedule of accounts receivable. They want us to do the bad debts and then do some adjustments on the adjusting entry. So in part 1, they give you all the information up here in this paragraph about how old each of the debt is. And then they give you all the percentages. It's 5%, 10%, and 20%. So down here, you notice you've got accounts receivable of 12, 5, 3. That's a total of 20,000. And then here's the percentages that you're going to apply to each of those weights. And all you have to do is multiply these percentages by the categories. 5% times 12, 10% times 5,000, and then 20% times 3,000. And then you add all these up and you would get 1,700. That would be your estimate for part 1. Now on part 2, it says they want to know, it says what amount of bad debts expense should be recorded on December 31st. And on part 2, it depends on what your allowance for doubtful accounts balance is. And in this problem, they give you that balance right here. It says the allowance for doubtful accounts balance was 800 with a credit balance. And so you have to take that in consideration. So what you do is, remember, we want 1,700 to be the ending balance. And so if we have 800, we have to add another 900 into the allowance account to get to that 1,700. So 900 would be your adjustment. That would be your bad debts expense on part 2. So that's what you'd write in there for bad debts expense. Then on part 3, again, they just change it. They say, what if the allowance account had a debit balance of 600? And again, you still want to get to that required balance of 1,700. And again, you do the same thing. So again, what you do is, get my arrow on here. So remember, 1,700 is your desired balance. So if that's 600, you had to plug a 2,300 credit into allowance to get to that 1,700. And that would be your expense if that were the scenario. All right, so that's my comments on, this is problem 3. Let's check out problem number 4. This is another note, receivable type of problem. So notice on part A, we loan $50,000. It's a 1-year, 8% note. So remember, it's a 1-year note. So you debit notes receivable, credit cash, that's $50,000. And then it says accrued interest on the note on June 30th. So if you got January, so that'll be what, 6 months. So you go January to June. So remember, and I'll write this out. Again, you've got your principal times interest rate times time. The principal is 50,000. So I'd write that there. The interest rate is 0.08. And then the time period would be, it's again January to June 30th. You'd say 6/12. And that would give you your $2,000. So you debit interest receivable, and then you credit interest revenue. Now, at the end of the year, they want you to do on part C, it says no interest has been recorded since June 30th. So the rest of the interest, again, it's the same thing because there's another 6 months to go. That's the other 2,000. So you're going to debit cash for 4 because you've got 2,000 interest for the whole year. That's debit cash, credit interest receivable from what you'd accrued on June 30th, and then interest revenue you haven't recorded yet. And then the last part is just simply recording the collection of the principal, which of course is just a debit to cash and a credit to notes receivable. And then I believe down below, they're just showing you the same calculation that it showed you on how to calculate that interest. All right, that's problem 4. Let's check out problem number 5. And on this one, again, they want you to figure out the write-offs during the year. So we'll look at the T account on that one. And they also want us to do a turnover ratio. This was in 2016. So you'll note they give us June 30th, 2015, June 30th, 2016. You've got net of allowance for doubtful accounts of 430 and 330 respectively. So we know 330 would have been the beginning balance and 430 would have been the ending balance. And it says, according to the Form 2K, they had bad debts expense and they did not recover any previously written off accounts during the year into 2016. So your basic setup on this, and I'll give you my version of the T account and then I'll show you their explanation to it. So what you'd want to do is, first of all, write out your allowance, just like that. And we'll say the beginning balance was 330. All right. And then the ending balance, I'll make this a little bit longer. The ending balance was 430. And in between, they had recorded bad debt expense of 150. So what would happen then, in order to go from 330 to 430, they must have written off something. So that's going to be your plug number. So if you go 330 plus 150, that gets you what, 480. So they must have written off 50 to get to that 430. So this is basically a plug number to figure out how to get to your ending allowance account. So again, this is the beauty of the T account. This is why I always teach T accounts in applied accounting, because it's a tool to help you figure out some of these type of problems that they're going to ask you. So in part 1, of course, it'll be 50 is what they would have written off. All right. Now, I believe in the second part, they want to know, and of course down here below, let me show you theirs. They're showing the same thing here. They just set up the T account and they had to plug in that 150. Now on your receivable turnover ratio, it's just your net revenue divided by your average receivable. So it's right here. Remember your average is beginning plus ending divided by 2. And so you get 4.7 as your accounts receivable turnover. That will be the second part. All right, that's problem 5. And then one more, let's check out problem number 6. It says that we have the following happen here. Notice that they've got accounts receivable, they have an allowance, and they have sales. So they're giving you this information as debits, you got the credit balances. And then on the first part, this one says assume that they have 1/2 of 1% of sales to estimate bad debts expense. That's the credit sales method. They want you to do the adjusting journal entry. And then on part 2, it says assume instead they use the aging. So they give you a little bit of comparison here with the credit sales method and the aging method. And then on part C, they're just changing a couple things, still using the aging method. And then part D, part 4, you're going to do a write-off of 15. So let's start with the first one. So again, 1/2 of 1% of your credit sales. Your credit sales are 18.3. So all you got to do on that one, I'll just show you this calculation. 1/2 of 1% is 0.005 times 18.3. That's how they came up with the 92. And that would be a debit again to bad debts expense and a credit to your allowance again for that 92. So that would be your first part. On your second part, they say, okay, assume instead of the credit sales method, you're using the aging approach. And it says they estimate that 80 of its accounts receivable will be uncollectible. All right, so they're basically saying they did the aging and they want 80. So at that part, you have to figure out what is your current balance in your allowance for doubtful accounts. So in this case, allowance for doubtful accounts, I believe, had 30. They gave you that at the start of the problem, which was right there. So if that's a credit of 30 and your desired balance is 80, then, and again, let me write this out. I think it's probably easier if you see this. If I put this in a T account, so again, here's your allowance. And unadjusted right now, it's got 30. and you want that ending balance to be 80, so your adjusting entry would have to be 50. That would be your plug number. So that's where they get that 50. So just simply debit bad debts expense and credit your allowance for doubtful accounts. All right, on part 3, they're changing it to, I believe it's a 20, it is a debit balance of 20 instead of credit balance of 30. So if it's got a debit balance of 20, and again, I like the T account. I think it's easier to show you as a T account. So if you've got, and here's your allowance. So if you've got, let's say, a $20 debit, and you want that ending balance to be at, what do we say, at 50, I think it's 80. So if you want that to be at 80, so you'd have to do an adjustment of 100, because 100 minus 20 would get you to 80. So that's where they'd get this. You would debit bad debts expense and credit your allowance for doubtful accounts for 100 to get you to be that credit balance of 80. All right, and I believe that's part 3. And then part 4 is simply just to do a write-off, and I think you've done this already. You simply just debit the allowance and credit accounts receivable for 15, because that's all you're writing off. All right, guys, I think that's it on my comments for the Chapter 8 homework.